While gold prices have been in the spotlight, silver prices have also rallied and are near its highest level in almost 13 years. Daniel Galley, Senior Commodity Strategist with TD Securities, joins us now to discuss. And Daniel, welcome back to the show on very interesting times.
Yeah, thank you for having me.
All right, so as I mentioned, it's very interesting moves in the silver market. Now, you say we've been seeing a price breakout. What's happened?
Yeah, what's interesting, right? Right now, the silver market is buzzing with this excitement because prices broke through $35 an ounce. That's been a range that's been very difficult to break through over the last several years. And the last time silver prices broke through this level, we traded $50 an ounce in a matter of weeks, within 6 weeks. So, of course, the excitement is building. We think this has been a long time coming. And in fact, we think the current market structure favors these kinds of mini squeeze events going forward.
Oh, okay, so walk us through some of the mechanics behind such moves. And we're looking at a bit of a global imbalance between the big trading hubs in London and New York, correct?
Yeah, correct. That is part of what has caused the imbalance in silver markets right now. Walking you through how this process has worked and how we think it might work going forward. The breakout itself, when we crossed through that $35 an ounce level, was a futures-led breakout. It contrasts with what you might expect, given that we're now 5 years running into a structural deficit. That deficit has eroded physical inventories, and you would expect such a breakout to be led by the physical side. That hasn't been the case, and as a result, it suggests more speculative activity in silver markets, which are or more difficult to forecast what might occur as a result of them. That being said, even though the breakout was futures-led, it might begin to change market psychology, right? The fact that last time we broke through this level, we rallied very substantially thereafter, might start to attract subsequent ETF inflows. Those ETF inflows are increasingly draining what little is left in the world's largest bullion vaulting system for silver out of London. Right, you have to think about this massive imbalance that has occurred as a result of the threat of tariffs earlier this year. A tidal wave of metal moved from London into New York because the relative prices between New York silver and London silver incentivized that move of metal. We're now left with a market structure in which London is critically scarce. There's less silver that is freely available for purchase in London than is typically traded on any given day. And meanwhile, you have this oversupply in New York, and yet London markets aren't pricing that scarcity, and the markets as a whole aren't pricing the incentives required for the metal to flow back to where it's actually physically traded. And this structure, we think, is going to catalyze a series of rolling mini squeezes, as we've called them, that should support a higher trend in prices.
Okay, now that's the supply side. What about the demand side? What are you seeing there?
Yeah, I mean, demand's doing just fine, right? The one thing that I will say since the threat of the trade war became more apparent is that most analysts out there expected a downturn in demand for raw materials, a downturn in the global economy, and we've not seen any sign of that just yet. Our proprietary gauge of broad commodity demand growth is now at the same levels that it was prior to Liberation Day. It's hard to know whether that's being unduly influenced by stockpiling and front-loading of demand, because the world still remains uncertain how the tariff outlook will evolve. But for the time being, demand is doing absolutely just fine.
Okay. Now, you sort of talked about the rising trade barrier. What about the scenarios that may play out from silver from here?
Yeah, so again, right, there is this major imbalance in where silver is physically located. There's only really 3 possible scenarios that we could see from here. One is the imbalance isn't resolved. That's the current state. In the current state, because physical silver is mostly traded out of London and there is a lack of availability, then firstly, the market will become increasingly illiquid, such that any demand for physical out of London will have a bigger impact on the price. Secondly, this silver that's available there is going to be increasingly concentrated among fewer market participants. And again, that fuels more liquidity, and that's really what drives our view of rolling mini squeezes going forward. The other 2 cases are, well, how do you catalyze, or how does the market create an incentive for silver to flow back from New York, where it's ample, into London, where it's scarce? two main ways that that could happen. One is you have to create an increase in supply of futures. The reason that that would catalyze this, it would catalyze this transportation arbitrage by advent of London prices being higher than New York prices. The interesting part about that is that we just went through a major liquidation event. Right, speculators, whether they're algorithmic traders, discretionary traders, in the aftermath of Liberation Day, we saw large-scale, massive liquidations from those cohorts, and that wasn't enough to catalyze the supply of futures required for this to occur. So what we learned from that is really the third option is what the market will have to rely on to address this imbalance. The third option is ultimately a rise in the price of London relative to the futures. And that goes back to our view of this successive series of rolling mini squeezes that are actually probably required to address this imbalance.
Okay, so given the scenario and given where we are, where we see silver prices right now, what does this mean for the prices going forward? Do you see further push higher for silver prices?
Yeah, absolutely. We forecast higher silver prices on the horizon. We think that we could trade $40 an ounce before the end of this year.